All right. Hello, everyone. Welcome to your weekly market check-in here with myself, Greta Wong, your host. I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussions, here is a quick disclaimer of Derrick's positions. As of earlier this morning, we're having a few technical difficulties with our website, so these are from earlier this morning. But the topic of our discussion here today, Derrick, is wartime market update because we are in a point of conflict now in the U.S., in the world, not in the U.S., but in the world, in the Middle East. The U.S. is involved. And this morning, the stock market was down, but wow, what a buy the dip we have seen. The Dow is down just 60 points right now. The S&P 500 and the NASDAQ have both turned positive. So what do you think about the market action we've seen in today's session after what happened this weekend?
Yeah, so I felt pretty uncertain at the open with the gap down on which way we would go. SPY 676 remains this massively important level. We tested it at about 4 a.m. this morning and held it. We bounced a little bit back pre-market, and then we've really bounced back since the market actually opened. We know from a positioning perspective, because it's one of the things I love to study is market dynamics and general market positioning, that a lot of market participants were kind of prepared for a down move to occur in the market. And that's a little bit of a mixed bag because on the one hand, if a lot of people own puts in the market and the market goes down, it can actually accelerate the selling because market makers could have to sell more on the way down to keep themselves hedged. The flip side is if everybody already owns puts, they can monetize those puts, and that would create a bid to the market. So the big question this morning when we opened up is, are people going to come in and quickly monetize their downside or not? And if so, we'll get back above 680 very quickly. If not, we could probably hang out below 680 and then eventually go after 676. We break 676, we could have pretty big repercussions on the downside. And they immediately bought this market back up. So far, this is a positioning squeeze. Now, traditionally, when it comes to these war invasion situations, the playbook is pretty standard on this. You get like a very quick dip in the market and you get a very quick bid in oil. And then they also very quickly reverse themselves. The question was, is this situation going to be different than kind of our traditional playbook? And there's a couple things that I would offer to you that are potentially different. One is, I don't think that this was as widely expected as some other events. Everyone obviously knew it was a possibility that we could bomb or invade Iran. And so far, I think it matters that there are no actual troops on the ground. It's primarily been an air campaign. I think that is more positive for the markets than if we send troops in. But I don't think that this was as widely anticipated. It was a possibility, but it was a big question mark compared to, say, the Russian invasion of Ukraine. When that happened, everyone knew it was happening. Russia basically told us the day and time that it was going to happen. And you saw the market sell for 8 days in a row into it. And then on the morning where the invasion occurred, the market had a massive gap down, and that was it. That was the bottom. It was a huge buyable opportunity, but we sold in anticipation of the event, and then we bought back when the event occurred. It's kind of like the buy the rumors, sell the news saying that you hear traders say so often. The difference here is that the market never sold down into this. So is there a possibility that then this morning people de-risk further and we break some support? And if you could break support, which did not happen, we have a lot of forced selling systematic triggers sitting right underneath your lows. So that was the big question. And now at 12:30 p.m. Eastern here, we have what appears to be an answer, which is that people came in and they very quickly sold volatility and monetized their hedges, and the market has had an incredible snapback to green at this point. This is the last opportunity, I think, for the market to break down. We have been in a incredibly long consolidation. As we've discussed in the past, it's been kind of a weird year because the S&P has done nothing this year. It's been extremely range bound, but under the surface for individual stocks, it's actually been massively volatile. The average stock in the S&P has moved over 10%, while the S&P has done nothing. Those are some incredible statistics. That term is referred to as dispersion. So dispersion right now in the market is near an all-time high. It's never traded like this in my entire career. So it's a new environment. But at some point, this S&P range is going to break. And it had a real opportunity to break to the downside today. I still think it has an opportunity to break to the downside this week. I don't think that, this bounce back in the market is very, very notable. I do still think that there is a chance that we could break lower, but you get through this week, get through the next few days, and we haven't broken down, then you start to get, I think, a greatly increased probability that this market actually resolves to the upside and breaks up, which also, from a positioning perspective, is not something that people are prepared for at this point. Everybody has those protective puts. A lot of those are being monetized this morning. And if this market starts to really break out and break to the upside, then it could create a big positioning squeeze. So for the moment, I'm still trying to be cautiously bearish. It's not impossible for us to have a half of a day positioning squeeze here to the upside that gets this market back to small green or unchanged and then roll back down. But without a doubt, the degree of the bounce back this morning is a win for the bulls.
When it comes to this conflict between, Israel, the U.S., Iran, and the rest of the world, really, a market that is definitely impacted is the energy market. See oil prices spiking today. Natural gas being shut down, you're not getting any natural gas. Iran, natural gas out of Qatar, the output there being totally halted because of the strikes from Iran. And so when it comes to the energy market, what are your thoughts on the impact there and what we've seen so far?
Sure. So oil is still up pretty decent, and it's up 5.5%, but it is well off of highs. Interestingly enough, and I'm more of a stock trader than a commodity trader, though. Occasionally, I dip my toe into trading some commodities, like when silver was going crazy. Interestingly enough, OIH and XLE are really underperforming. OIH, Oil Services ETF, has gone negative. And XLE, which tends to benefit at least to some degree of an increase in prices and energy, at this point is only up 1.25% and is well off of highs. This has been my favorite sector to be long all year, even prior to the Iran situation coming out. It remains that way. But if they don't close XLE well today, if they close it on lows, I think it's going to be a big signal for anybody who's been long the energy stocks take a big step back on their exposure, take a big pause. And for anybody who's looking to push the upside, to be patient and wait. So you need to see how this XLE closes. But so far, they sold the gap up in the same way that they bought the gap down in the market.
Besides just the oil impact, there's definitely also an impact on the global economy and shipping and all of that. Shipping giant Maersk saying today they're suspending all of their operations through the Strait of Hormuz following the strikes over the weekend. The strait has not been officially closed by Iran at this point, but companies do not feel safe traveling through there. And that is, of course, the key passage for shipping giants, oil companies, anyone going through the Middle East. So when we think about the economic impact, we're not going to see that today, tomorrow, next week. We're going to see that, months down the line, and when it comes to supply. So, as a trader, when you think about that, how do you think about that in terms of what it could do to the market and specific stocks?
Sure. So that was exactly one of the things that I brought up today in my morning meeting when I was going over kind of what I just discussed with you, which is to what degree has the market already priced this in prior to it happening? will we see a de-risking off the open that causes us to break support, or will we get bought back up? And now, again, we've gotten bought back up. But that was one of the bigger things that I was pointing to is if the market wasn't fully anticipating this, if it wasn't fully priced in, a lot of the times when you have the situation of, all right, the war starts, so they already sold us off, and now the playbook says buy because we're always up 3 months later, 6 months later, and 12 months later, whenever these war situations begin. Is this going to be different because maybe the market wasn't fully pricing in the Strait of Hormuz being potentially shut down? And even if it's not directly shut down, it's shut down through proxy, just basically meaning shut down because the insurance companies aren't going to insure the boats that are going through there anymore. And that's the exact same thing. I would think that would have a big economic impact. It would have an impact on oil, and oil prices going higher has an impact on the economy. This was all part of my thought process this morning when I was trying to consider what the probability is of us breaking 676 support in the SPYs. And what the market is telling you and I right now, Greta, is it doesn't matter. That's what it's telling us for the moment. And like I just said, I still think that there's a chance here that we're getting like a big opening positioning squeeze just because of how many people were prepared for market downside. There is a chance that we roll down either this afternoon or tomorrow. I've sometimes seen these situations where you get these macro events, they gap us down, they buy us up, and then the next day the selling comes in. I'm leaving open that possibility. But for the moment, what the market is telling us, and sometimes I like to think that I'm smarter than the market, and it always proves to me that it's smarter than me. What the market is telling us is that thought process that you just laid out, Greta, which I think makes perfect logical sense, and it's exactly what I was reviewing in my morning meeting today. The market's saying it doesn't matter, it's fine, it's going to be okay. Don't worry about those boats; they're going to get through.
I guess we'll see who is right when it comes to the end of this. All right. Besides all of the war talk happening for the market, there is a lot more happening for the market. You and I haven't talked post NVIDIA earnings. There was, it was a huge earnings week last week, not just NVIDIA, but a ton of software companies as well. And there are some more big earnings coming up this week also. So when it comes to this end of earnings season and the companies that we're currently getting reports from and recently got reports from, what are your thoughts on this part of earnings season? You and I have talked, of course, about overall earnings season and how the market has reacted, but post NVIDIA report, how are you feeling about the market?
Yeah, so NVIDIA gave such a clear signal the next morning when I was doing my morning meeting. So I guess that was Thursday morning that it was going to sell off. And that signal was very simply that the stock was basically flat at that point. The numbers were great. It started to break out in right in front of the report on Wednesday. They were buying it up. Immediately after, it was above $200. It should have went, it should have squeezed, and it didn't. When I was doing the morning meeting, it was trading at 197, and the SMH, the semiconductor ETF, had a potential false breakout above 420. And I told everybody on the team, Greta, you and I talk about it all the time. It's one of my favorite signals in trading. When a stock should do something and doesn't, a lot of the times it's a big signal for the other direction. And NVIDIA was that perfect case in point there. What are you doing flat on the morning after your earnings report, after you just crushed the numbers in such a way that you beat the expectations of everybody on the street? And that morning there was like 10 price target increases from sell-side analysts to $280 and $300. And the stock is flat. It should not be that way. So was not surprised at all. And I was positioned for it. I was short SOXL, I was short SMH, I was short the Qs, positioned then for the stock to actually break down. And it had 2 heavy days of selling, Thursday, Friday, gapped down this morning along with the market, and is now giving a little bit of an oversold bounce. But if anything, the most incredible thing to me is NVIDIA, the most important stock in the universe with such a huge market cap, sells down like that for 2 days in a row. Then over the weekend, we get the Iran thing that happens. And yet the market itself still holds support. It can't break. If NVIDIA is selling down, the biggest company by market cap selling down, can't cause us to break support, can't increase correlations and cause other things to sell as well. If the geopolitical events can't cause the market to sell down and break support, is there anything that can cause this market to break down and sell support and break support? Or are we ever going to see a market that goes down ever again in the history of the universe? It almost seems like the answer to that is no, if we don't get the sell-off soon. So yeah, just incredible that NVIDIA was able to sell down and the market didn't is even more impressive to me than the fact that NVIDIA sold it in and of itself. But it's continued rotation. If the other big sector that everybody's still looking at is software. You can look at the IGV ETF. IGV had a false breakdown as SMH, semiconductors, had a false breakout, almost in conjunction with one another. And from a failed move comes a fast move. And since that has happened, IGV has been relatively strong. IGV is up 1.5% today, and SMH has been relatively weak. Even right now, with the big market bounce back we've had, SMH is only flat on the day. So it's dispersion, it's rotation, it's mean reversion. That has been the name of this game until we see this market break in one direction or the other.
All right, and the other big news of the week is, of course, that it is jobs week. It is March. It's March 2nd. It's the first trading day of the new month. So ADP will release their private employment report Wednesday ahead of the open, and then the official non-farm payrolls report from the Labor Department will be out Friday morning. This comes after we got some hot inflation data last week, which had the market concerned for sure, because the Fed has said, hey, we're focused on jobs, inflation is doing fine, we're not really worried about inflation anymore, and then boom, hot report. Maybe they do have to be worried about inflation. So with that, how are you feeling about the jobs report this week and what it means for this market? And of course, obviously, the market cares about what it means for the Fed and what the Fed does from here.
Yeah, so you just said it. Seen some concerning inflation numbers come out again. The last jobs number was better than expected, if I remember correctly. And I think that expectations are high for this jobs number, that it's going to be a pretty decent number as well. So if that's the case, if people are working and we're not seeing the AI labor apocalypse and inflation is still higher than where we want it to be, why is the Fed going to cut? There's no reason at all for the Fed to cut. They have a dual mandate, and jobs have held in better than I've expected, and inflation is staying stubborn. So why cut? We'll see what the number is. We'll see how the market reacts to it. But I think that we're looking okay. And the other thing that I would throw in there, which is a similar but different thought process that people need to pay attention to now as we get into this time of the year. The biggest buyer in this market outside of the companies themselves has been retail for quite some time now. And retail is going to continue to buy as long as they have jobs. So that's why it's been so important to pay attention to that. But also, a lot of people are in the process of getting back some major tax refunds. And those tax refunds are going to go into the economy, and they're going to go into the stock market, which is one of the reasons why I keep saying, if we can't break down ASAP, like this week, I really think this market needs to break support this week. And it's probably not going to happen, and we're probably going to break higher just because there's going to be more money beginning to pump into this system, and then it's going to cause us to break out. So if not down, then up is what we're looking at.
All right, like I mentioned, it is a new trading month. It is officially March, which means February is over. So when you and I, at the beginning of February, when we talked about kind of expectations for the month, you talked about how it's typically a seasonally pretty weak period for the market. And it's definitely been, when I think about the beginning of 2026, January, and then also February, it's been a really hard market because it's been a really choppy market. There's not a lot of direction up or down. It's just, go up one day, down the next. We go up in the morning, down by, hard market to find a lot of opportunity in. So when you look back on February, what are your thoughts?
Yeah, so I had a pretty good February. The indexes won't give any follow through, but I do think that there's been a lot of trading opportunity underneath the surface, just because, again, dispersion. It's like all you need to do is look at the semiconductor ETF and look at the IGV, the software ETF, and that's an example of every sector to some degree, but those are probably the most extreme ones, where there are things that are trending higher and breaking out and really continuing to the upside. There are things that are trending lower, breaking down, really continuing to the downside. And I am a big believer in trend following, but then in periods of extreme going counter trend. So sectors and stocks, even though the market itself hasn't done it at all, sectors and stocks have given great opportunities to trend follow and then to go the other way into that extreme extension. There were periods of time when we started to go long software, or we started to go short semiconductors, where I was shorting consumer staples at one point in like early mid-February when that was getting extreme. I was shorting utilities, XLU. I never trade XLP. I never trade XLU. I never touch these sectors. They're typically so boring, but they're just giving these outsized moves of going up 6 days in a row and gapping up on day 7 and giving you an opportunity to put in an extreme short in XLU. That's a great little 2-day mean reversion trade. Like, whoever thought that that would happen? So I think that if you, and by the way, this is why I'm a stock trader, because I think a lot of people I know, it's becoming more popular than ever to only trade futures and only trade the ES and the NQ and the indexes and maybe a commodity here or there. I find that to be very reward limiting. If you are only trading ES, you're probably pulling your hair out with how this market has traded recently, that you can't get any follow through in either direction. But if you're trading these sectors and you're trading stocks, it's just a tremendous amount of opportunity to be trend following and then looking for extreme extension mean reversion opportunities. So I actually think that if you just look at the S&P, February looks like it was terrible, but underneath the surface, the fact that the average stock in the market has gone over 10% while the S&P has gone nowhere is breeding a lot of really good trading opportunity. And I had a good February. I was able to take advantage of it. So no complaints on my end.
Yeah. All right. So then March, let's get your outlook for March when it comes to this month.
So I want to say that I don't think that this range can continue. I want to say that we're starting to reach a tipping point where this range is going to break in one direction or the other. When the range breaks, correlations are going to increase. So we, again, have been in this very, very unique market environment that I've almost never seen throughout the entirety of my career. I think that that's going to change at some point soon. I don't have a crystal ball where I can tell you where, but it seems like it's coming to a head to me. And then it's just a matter of which way it breaks. That's the biggest thing that I'm paying attention to. And I've been saying it over and over and over again. My biggest focus right now is the market itself. We're already $11 off of our 4 a.m. low in the SPY as we're having this conversation. We're therefore $11 off of support. And now we are only like $8 to $10 away from resistance. We just went from like a hair away from breaking support this morning to actually closer to our range resistance than that range support. But I guess you could argue that we're somewhere in the middle here. It's just really a matter of which way this range breaks and being positioned for it, because I think that whichever way we do break is going to be it's going to lead to a really big move. And I have been leaning towards that being to the downside. But every day that goes by where we don't break, I become slightly more bullish. And I'm trying to have that be my portfolio as well. Really was trying to press the downside over the course of the last week. Was excited to see the futures down big this morning because I had so many puts on, so many shorts on. And, we've already snapped back really, really significantly here. So the biggest thing for March is which way does the range break?
All right. And then when you're looking at this market, like you said, when you look at the index level, things are kind of tough, and you got to be digging under the hood to find the best opportunities in this market. So when you're looking and scanning for ideas, what are some of the names and the charts that you're looking at if we want to look at some charts?
Sure. So again, SPY 676 on the downside, 695 to 698 on the upside. That is just the first and foremost most spot. Whichever way the market breaks, correlations increase. So you need to be thinking about the market in terms of if-then statements. If we break down, then these are my expectations. If we break out, then these are my expectations. So all of my ideas for going forward are based on that if-then statement. Are we breaking down or are we breaking up? If we break down, I think that the market sees the 200 SMA very, very quickly, which is all the way down at 655. This market, which can't break this, 15-point range, I think we'll see 20 points of downside extremely quickly if that were to break. I think that within the confines of that, software actually might show relative strength. And that's because the positioning in software right now is like more short than it's ever been and less long than it's ever been, or at least back to 2018, based on some of the data and research that I've read. So it's been tricky, but I've been like trying to maintain, again, I don't know if we're going to break out or break down. I've been trying to maintain longs and maintain shorts at the same time. So I do still have like a long on in Microsoft. I do have some NVIDIA long at this point. I do still like some of the other software companies. I like SentinelOne, symbol S. That's going to move based on CrowdStrike this week because they're in the cybersecurity space. I like this ESTC, which got really beaten up on what I thought was a pretty darn good earnings report, trading down to $50 now. I think that there's value in that play. So I'm trying to have some longs on in case we break up, but if we were to break down, correlations are going to increase, and I don't think that there's really going to be anywhere safe to hide except for possibly energy. I think energy is going to be potentially the one place that you can hide if this market were to really break down. So I just want traders to be really prepared. We're in the midpoint of this range right now. Go through a series of if-then statements. How are you going to be prepared? How are you going to be positioned if we lose 676 and really break down? How are we going to be prepared, and how are you going to be positioned if we break the 695 to 698 on the upside and really break up and continue? I think that there's going to be the potential to make a lot of money on that directional move when it happens, and traders just need to be prepared for it and not be caught the other way. Don't be trying to short the market as soon as it's breaking out to the upside. Don't be trying to buy the dip in the market at 674 when we just broke support by $2 and volume is increasing and we're breaking lower. So again, it goes back to the trend is your friend, and at a certain point, momentum is going to be your friend again. It's just a matter of which way do we break.
All right. Sorry, I'm going to flip back on camera. All right, Derrick is a real trader. Again, he is the head trader at T3 Trading Group. If you like what you've heard today and have any interest in working with him, you can go to t3live.com/DOLive, fill out that form there, and someone from Trading Group will get in contact with you. Again, Derrick is the head trader there and leads the ProDesk virtual trading floor, which is where all the traders from T3 Trading Group work together on a daily basis. So you can go to t3live.com/DOLive. Derrick, thanks so much for your time today. Hope you have a great Monday and get some good catalysts ahead for a good trading week.
Thanks, Greta. Have a great day. I'll speak to you soon.
All right, great.